Welcome back to our channel, where we break down personal finance topics to help you make smarter money decisions. Today, we're diving into a timely subject: how the Federal Reserve's recent interest rate cut impacts certificates of deposit, or CDs, and what that means for you as a consumer. But before we get into the effects of the rate cut, let's quickly review what a CD is. A certificate of deposit is a savings product offered by banks and credit unions. When you open a CD, you agree to deposit a specific amount of money for a set period, typically ranging from a few months to several years. In exchange for this commitment, the financial institution offers a higher interest rate than you'd get with a regular savings account. The key features of a CD are a fixed interest rate for the entire term, a guaranteed return, assuming the bank is FDIC insured, and penalties for early withdrawal. CDs are considered low-risk investments, making them popular among conservative savers and those nearing retirement. Now, let's explore how the Federal Reserve's decision to cut interest rates impacts CDs and consumers. The most immediate and noticeable effect is that banks will likely lower their CD rates. When the Fed cuts rates, it becomes cheaper for banks to borrow money. As a result, they don't need to offer high rates to attract deposits from consumers. For example, if you were eyeing a one-year CD with a 3% APY before the rate cut, you might now find that same CD offering only 2.5% or even less. This means your potential earnings on savings will decrease. It's important to note that if you already have a CD, your rate is locked in for the term of that certificate. The rate cut won't affect your existing CD. However, when that CD matures and you're looking to open a new one, you'll likely face lower rates. For those using a CD laddering strategy, where you stagger CD maturities to take advantage of potentially higher rates while maintaining some liquidity, you may need to reassess your approach. As shorter-term CDs mature, you'll be reinvesting at lower rates, potentially reducing the overall effectiveness of your ladder. Let's break down the pros and cons of this situation for consumers. While not directly related to CDs, lower interest rates mean cheaper loans for mortgages, auto loans, and other forms of credit. This can be beneficial if you're planning major purchases. Rate cuts are intended to stimulate economic growth, which could lead to better job prospects and wage growth in the long run. And if you act quickly after a rate cut announcement, you might be able to lock in a CD at a higher rate before banks adjust their offerings. However, there are some downsides. The most obvious is that your savings won't grow as quickly with lower CD rates. Many retirees rely on interest income from CDs and other fixed-income investments. Lower rates can significantly impact their cash flow, and with lower CD rates, some savers might be tempted to seek higher returns through riskier investments. If you're a CD investor, here are some strategies to consider in light of rate cuts. Shop around. Different banks may adjust their rates at different times and to varying degrees. Compare offers from multiple institutions to find the best rates. Consider online banks. Online banks often offer higher CD rates than traditional brick-and-mortar institutions due to lower overhead costs. Reassess your CD ladder. You might want to adjust your ladder strategy, perhaps incorporating some longer-term CDs to lock in higher rates for a more extended period. Look into bump-up CDs. These allow you to increase your rate once during the CD term, which can be beneficial if rates start to rise again. Don't forget about penalties. With rates lower, early withdrawal penalties can eat into your returns more significantly. Be sure you can commit to the full term. When opening a new CD after a rate cut, pay close attention to the fine print. Some CDs offer a short grace period after maturity. The length of the grace period can differ between banks. For example, Wells Fargo offers a 7-day grace period, while Chase provides 10 days. Why, you may ask? Is there a grace period after maturity? Let me explain. When a CD reaches its maturity date, it means the agreed-upon term has ended. During the grace period, typically 5 to 14 days, you can withdraw funds or make changes to your CD. This period exists to give you time to decide what to do with your funds. Do you want to withdraw, renew, or change terms without being locked into an automatic renewal? This can be useful if you're unsure about reinvesting at lower rates. Once a CD matures, and during its grace period you can withdraw all funds, you can renew the CD or change its terms. If you take no action, many banks will automatically renew the CD, often at the current interest rate for the same term. Is it important to have a grace period at maturity? The answer is yes. They provide a brief window of flexibility in an otherwise rigid financial product. This period gives you time to reassess your financial goals, current market conditions, and other investment opportunities before deciding whether to renew the CD or explore other options. And if you need the funds immediately after maturity, the grace period ensures you can access them without incurring early withdrawal penalties on a renewed CD. Check if your CD will automatically renew at maturity and at what rate. You might want to disable this feature to avoid being locked into a lower rate. Some higher-yield CDs may require larger minimum deposits. Ensure you can meet these requirements. Confirm that your deposits are within FDIC insurance limits, especially if you're opening large CDs. While Fed rate cuts can be challenging for CD investors, understanding their impact allows you to make informed decisions. Remember, CDs are just one part of a diversified savings and investment strategy. Consider your overall financial goals and risk tolerance when deciding how to allocate your money in a low-rate environment. Thanks for watching. If you found this video helpful, please like and subscribe for more personal finance tips. And let us know in the comments how you are adjusting your savings strategy in light of the recent rate cuts.